For the average person, debt functions as a trap. It triggers a cycle of monthly payments and compounding interest that leads directly to ruined credit, lost assets, and chronic stress. Yet the richest people on Earth take the opposite approach. They finance their private jets, mansions, and daily lives using borrowed cash. These multi-million-dollar loans are taken out with no intention of ever paying back the principal. Borrowing millions while refusing to pay it back would drive a regular person into immediate bankruptcy. The mystery lies in the math that allows a billionaire to do this and actually grow wealthier in the process. The destructive power of debt is an illusion suffered by the middle class. When utilized correctly, debt transforms into a highly engineered tool for leverage. Middle-class debt is income-backed, meaning it relies on an unstable job and is typically used to purchase depreciating assets like cars or consumer goods. The wealthy utilize asset-backed debt. They secure their loans against highly stable, appreciating assets, massive portfolios of public stocks, land, and prime real estate. This relies on a low loan-to-value ratio. Borrowing a small fraction of a massive asset pool eliminates downside risk. With massive collateral, banks drop interest rates to rock bottom and remove the requirement to pay back the principal. This shift in the power dynamic turns the bank into a highly flexible liquidity partner rather than a punishing lender. It seems counterintuitive for someone with $50 million in assets to walk into a bank and ask for a $10 million loan just to cover their living expenses. Selling assets trigger capital gains taxes, but borrowing is tax-free. Over 10 years, while paying minimal interest, the $50 million portfolio doubles to $100 million. They then refinance, taking a $20 million loan, closing the original debt, and pocketing $10 million untaxed. This cycle repeats for decades, relying on the fact that diversified assets historically grow faster than low-interest debt. This system functions as a mathematical engine, specifically designed to extract spending power while permanently starving the IRS of tax revenue. This strategy reaches its final stage when the borrower dies, leaving behind a mountain of debt and a massive portfolio of assets. The fate of these assets when inherited by the family reveals the final mechanism of this loop. Under the step-up in basis rule, the tax system resets asset values at death, instantly erasing decades of taxable profit. The heirs inherit the $100 million portfolio, selling a tiny tax-free fraction to wipe out the final loan balance. The family then takes the remaining fortune and restarts the borrow and refinance cycle, compounding the wealth for the next generation. This intergenerational shield legally separates endless wealth from the income tax system forever.